Management can use a different method of allowing for its bad sales or bad receivables, i.e. sales or receivables they think they won't collect. This method, the sales method, the focus is over here on the income statement, not on the balance sheet. So the idea is that management will look at its total sales and figure out what percent of these they think they're not going to collect. Well, here I have an example. Let me show you what we have. We have receivables at the beginning of this quarter. It was 10,000. They had 100,000 sales on account. They've collected 90 of those, leaving a balance of 20,000. And I also want to show you that there was also an unadjusted allowance balance of 100, meaning they had 100 too much, that they had let me say it this way, they had overexpensed 100 last year. They didn't need that entire allowance. So here management is at the end of the quarter, and this is often used on a quarterly basis when the SEC requires companies to do or to report their earnings quarterly. The sales method is pretty quick to use because you're not having to analyze all your receivables like I showed you with the aging of receivables. All they have to do is take their total sales or credit sales and multiply it by this percent, and that will give them their desired amount for their expense. So basically, if you look at it now, our net income will be only 99% of our sales because management thinks 1% of these are no good. So you're expensing or reducing net income by that 1%. Now the other side to that entry is you debit the expense and you credit the allowance account. Now, as far as the balance sheet goes, we still have our 20, but our allowance balance, because it had 100 left, it will now have a balance of 1,100. Now, had this unadjusted balance been on the debit side, that our balance here would have been just 900. So again, this method is not as good of a method. It's not as precise as the aging of receivables method, but it suffices for, say, quarterly reporting. And again, it's not as good because you're taking a percentage of all of your sales, of which many of them you've already collected. But it's an acceptable method. I'll tell you though, again, most companies will use it on a quarterly basis or during the year, the first 3 quarters, but for the final quarter in their year-end financial reporting, they'll typically use the aging of receivables. And again, the aging of receivables differs from the sales in that management's focusing on what they want this balance to be. So that would be the desired balance. They'd figure that out based on looking at their receivables closely and say, well, we think this amount's not going to be collected. And then the amount of the entry that you make, the amount you expense, will depend on what the unadjusted balance in your allowance account is. So, recap, sales method, what you're being told is what the expense needs to be. With the aging of receivables or the receivables method, you're being told what the ending allowance balance needs to be on your balance sheet. Well, I hope that helps.